Good morning, Jags. This is Fahad. Today is Monday, June 8th. Good morning, gang. How's everyone doing?
Good morning, doing fine. Hope everybody else is doing fine too.
Morning.
Morning.
Great stuff. Okay, so when I'm looking at the NASDAQ or the total market futures this morning, and it's the same theme that continues to emerge, which is really has been the case for last several days now. As everything starts to reopen, it's the Russell 2000 index, which has a lot of the dead bodies from the COVID shutdown, which are the small caps and the mid caps, particularly in the airline space, as well as the retail, the restaurants, and all those service industry, small cap, mid cap stocks that continue to basically power higher. Some of them have just basically reached levels that are quite amazing and how quickly this recovery has been. So, for example, Dillard's in pre-market is gapping higher after closing at 37. It's going to open at 40. So that's another 10% higher in pre-market. Similarly, Kohl's, a retail stock, closed at 26. It's going to open 28 plus. So another 7-8% in pre-market. And if you go down the list to all of these airlines, they're all gapping higher. So American Airlines, AAL, is up also about 6% in pre-market. Delta Airlines, after closing at 34, is going to open at 36 plus. Southwest Airline, which is one of our favorites that I've mentioned many times, closed at 38, going to open near $40 in pre-market. So all of these airlines, even Boeing, is up 10%. So there's a lot of these names that in the same category with the reopening theme that continues to power higher. I shared a video in Telegram on Friday, or actually over the weekend sometime. I hope you all got a chance to see it, but that was about Las Vegas and how we're seeing Las Vegas come back so quickly. It's quite amazing. People walking around, eating, sitting on tables. There are no partitions between chairs. And Las Vegas is back to full speed with absolutely as if nothing even happened. And so naturally, that is having a positive impact on Wynn Resorts, which is going to open up another 5-6%. Las Vegas Sands the same way, close at 52 and trading 54 plus in pre-market. But on the other hand, while we're doing all of this, if you then look at NASDAQ, which was the biggest beneficiary of the shutdown because of all the growth that led to into all the tech space that was modernizing and digitizing and e-commerce trends and all those. Nasdaq is taking a break again in pre-market, is actually down slightly, while Russell 2000 is up 2.2% in pre-market. So, the pain trade for the last couple of weeks for a lot of people have been the ones that piled into all these growth stocks in the tech sector, while completely ignored the price action and all that stuff on the Russell 2000 index. That's where the pain trade. It is not the pain trade on the entire market. It's basically how you position yourself. And so for us, for me, I've been able to actually play some of these strong trends, but I have stayed the course with some of the big cap value names, as I pointed out, growth to value. But instead of trading some of these small caps and the mid caps names, a lot of the recommendations that we have made, which we took off in the last week, we took profits along the way, have been in the big cap tech space. So UPS, JP Morgan, and a whole bunch of other names that we discussed last week. So we'll watch how things go. I also discussed the market internals on Friday. We are quite a bit stretched over here, but what's really powering higher is really the small caps, Russell 2000 index. That's where we're at. That's what's actually really powering things higher, while NASDAQ and everything else is taking a break. Now, with that said, staying on this path, the same path of growth to value rotation and such, I do want to discuss one stock in restaurant, which is Shake Shack. Now, I believe it was, excuse me, last week or the week before that in one of the conversations, Avo pointed out that this stock is setting up for a breakout. Shake Shack did indeed had a very nice breakout on Friday. It did close. It came back a little bit during the middle of the day, but this is a very interesting breakout. And if you look at the long-term weekly scale, you'll see what I'm talking about. It's now through the major VOP resistance. and it's down. It's also through the downtrending resistance. Now, a couple things that caught my attention on this one was notes that came out from Credit Suisse after discussing with management. And in this theme right now, the biggest thing is for a lot of these restaurants to reinvent themselves, to continue to push into the e-commerce trends where they're taking far more orders online, a lot more deliveries, less dining space. And so that's the theme that continues to emerge for the entire restaurant group sector. And here, Credit Suisse, this was on June 3rd. They discussed that over the last couple of months, the digital mix has grown significantly, reaching 84% of the sales for the week ended April 29 from 18% for the week ended March 11. So you can see that the digital mix went from 18% in the month of March to 84% of the total sales in less than 6-week time frame. The digital average weekly sales volume more than tripled over the same time period as well, to $41,000 for the week versus $12,500. SHAK has also noted in the first quarter earnings call that in early May, the number of guests purchasing through SHAK's proprietary digital channels has more than doubled over the last 8 weeks. And so this is a very, very positive trend that is emerging in Shake Shack. And this was the first time the company actually has discussed how the digital trend is performing. So I don't believe that it's fully baked into consensus view at all. This is the first time this picture has just started to emerge in the last 2 to 3 days. So I think that more and more analysts are going to start to catch up to this particular story. And the digital trends generally carries higher margin. You basically are working more and more towards, or you're evaluating these businesses more as commercial kitchen opportunities rather than whole restaurants with dining room and such. And so the volumes, is easily scalable with the delivery business, and as well as the margins are much better. So this is the new trend from Shake Shack that's going to become a new sticking point going forward. One has to wonder what the future earnings outlook for this company really looks like. And quite frankly, looking at these comments, it would suggest it should be much better coming out of COVID than what we have seen in the past. And similarly, in the same file, some of these charts are also worth mentioning is the Shake Shack's weekly digital mix. So take a look at this. This is what I just discussed. You can see how it was only 18%. Look at the drastic change. So now we're above 80%. My view is, when I look at trends like this, that even if the businesses reopen and we get back to normal, these percentages are not going to crash and come right back down to what it was before COVID. I think that 70 to 80% digital mix will become a potential new norm for the company. That means higher revenues, more volume sales, and higher margin business has taken over for the commercial kitchen opportunity than the dining space. Similarly, the average weekly digital total sales, which includes the digital as well as in-Shack sales, continue to gradually move higher as well. Now already back to what they were, before March 18, at the peak of the shutdown. So these trends have emerged, and yet when I look at the stock, which is just starting to break out, I think this breakout is going to last. It's going to have some legs, maybe a little bit consolidation, bull flag, but the way a lot of these small caps and the mid cap stocks are running, I think this could easily start to get more and more power candle back to back, and could have ways to run all the way to potentially $80 or even $90 per share. So something to keep an eye on. So this is Shake Shack, and I just want to quickly touch upon Blooming Brands, which is another restaurant. This is the company in which I one time took Jay and Avo for dinner when they were visiting me in Plymouth, Michigan. We went to the Fleming's Steakhouse, if you guys may remember. And that restaurant is owned by Blooming Brands, as well as other higher end restaurants that are all of them. So Blooming Brands is another restaurants, but I just wanted to quickly mention, because if you look at the option chain, you will see there is large 10,000 plus open interest in the January 10, as well as the 15 strike call options. They were buying the 10 strike call options. We mentioned this in the chat room. This was actually back in April, looking for a recovery. And last week they came and they bought 10,000 of those January 15 strike call options as well. The stock closed at 1370. It's going to be gapping slightly higher, but once again here too, they're looking for recovery, potentially all the way. And looking at the chart, there is no resistance in this stock all the way to $18 per share. That's where the VOP resistance comes in. So I think this has more room to run. So blooming brands with the large call buying and fine restaurant dining space coming back. But SHAK is the story that catches more of my attention with the digital mix improving. So let's see how this thing reacts. So that's all I have to share for today. Chronicle, you have a play that's coming up on REXR. Oops. On REXR, Rexford Industrial Realty. We need to do our video on that one for JaguarMedia as a separate one. I have your entire write-up and everything. I want to share this article real quick. And this one came from The Economist, which caught my attention, where the e-commerce boom makes warehouse houses hot property. The e-commerce boom makes warehouses hot. Very interesting article because I've seen some other anecdotal evidence, reading some local newspapers and such, that there has been more and more capital investment that's being made to reinvent a lot of the warehouse properties across America because the e-commerce boom has suddenly created a shortage of a lot of those warehouse properties around the country. Some need to be just just renovated to basically become fulfillment centers for large e-commerce trends that are appearing around the country, and some needs to be just simply bought out or built out from scratch to create more floor space. And so staying on the same theme, you have a play coming up pretty soon called REXR. Tell me about it.
Sure, I'll just preview the long idea I've been working on. So this is more of a long-term horizon investment rather than a trade. Rexford is an industrial REIT that is focused purely on industrial real estate in Southern California. And what they do is they specialize in acquiring property that's located in infill regions where it is very difficult for new competition to come in, and where it's also not easy for new property to get built due to lack of land. Therefore, the warehousing and logistics scene in the SoCal region is quietly one of the hottest real estate markets nationwide. And because the company is the only industrial REIT that operates locally, they tend to have the deepest connections in the region. In terms of portfolio quality, Rexford is head and shoulders above their peers, with a high occupancy rate in the nation, with the highest occupancy rate nationwide, around 98%, as well as one of the highest rent per square foot at 93 cents a month. The balance sheet looks solid as well, with pretty low leverage. So all of this is the long-term investment bull case. Meanwhile, I'm also seeing a couple of medium-term tailwinds. First of all, more than a third of Rexford's most recent leases are e-commerce related. And the key thing here is that 100% of their entire portfolio is located within last mile logistics. So these guys know what they're doing. From
Yeah.
a rent perspective, this is bullish because e-commerce typically requires 2.6 times as much space compared to other types of industrial usage. Secondly, rent rates in the SoCal region have been rising pretty steadily throughout the years, so much so that Rexford's total rental revenues was up 32% year over year in 2019. And if we look at their tenant contracts, roughly 1/3 of their leases are going to be expiring this year and next, which is great news because the leases are currently around 15% below current market value. So all the renewals that are going to happen soon will probably result in organic rent revenue growth. In other words, an improvement in releasing spreads. So these are the two biggest bull cases for the stock right now in the medium term. It's not very widely covered by sell side. And so I don't think there's a lot of market efficiency in the stock price, which represents opportunity in my view.
This is great stuff. I'm looking forward to doing that video with you where we'll discuss the Rexford Industrial in more detail, slide by slide, exactly what's going on, why we like this name. the thing that you mentioned about rent being below market, as well as the attractiveness of it, as well as the actual growth rate of 35%, that's just phenomenal. It's very difficult to find those kind of growth rates, but this is a potential secular trend now that is favoring the company right now, with the e-commerce penetration increasing and accelerating in many parts of the country. Just going to quickly mention real quick, and it's sort of related to this, but there was this article on Wall Street Journal that caught my attention as well. This came out last week or over the weekend as well, where the FedEx adds new delivery fees to manage a strain from coronavirus. Basically, if what's happening here is UPS and FedEx are both instituting surcharges on e-commerce deliveries of about 30 cents on a package of $30. So basically about 1% surcharge for oversized packages. And these kind of surcharges are usually implemented only temporarily during the holidays, during the Christmas time, when the activity is quite strong. But this time they're making it permanent. And so these are just brand new surcharges. And the move follows surcharges for peak air shipments, as well as the suspension of service guarantees put in place in the early days of COVID-19. And these fees are adding up and likely won't stop, as the capacity of current U.S. delivery logistics is far below where it needs to be, both now and long term. And so very interesting article over this, and this naturally plays bullishly for UPS, for which you have already presented the bull case on JaguarMedia, as well as for FedEx as well. Just trying to connect the dots, because it's all the big theme is all centered around the same logic, which is the acceleration in the e-commerce trends and such. All right, Jay, you have a fun stock to discuss. What's up?
Hey, what's going on? So today I have a small cap med tech company. Most Jaguar clients know about this, is OrthoPediatrics. Symbol is KIDS.
Yeah.
We first wrote about this way back in 2018, and it's been a great buy and hold stock. It's up approximately 175% since that write-up, and it's not covered by the sell side, not by a lot of analysts. So there aren't a lot of notes that come out, quarter to quarter. But today, BTIG is raising their price target to 54 from 48, and really the bulk of the note is on distributor checks that they had across the United States, and just looking at the different segments that they covered. In terms of trauma cases, they said distributors are beginning to see larger cases resuming in June. With regards to scoliosis cases, they also remain strong in June, while nothing in that category has been delayed. Elective deformity, while not back to 100%, there has been a recent uptick as parents have been bringing their children back into the clinic. All the distributors talked about how they have not been constrained by any sort of lack of instrumentation. In fact, they have been wanting more sets for their business. And channel checks, according to BTIG, also talk about strong physician education initiatives for new products from the company. So ultimately, BTIG, while consensus is expecting revenue of 10.7 million in Q2, BTIG is higher at this point and comfortable with their $11.5 million estimate, as they've clearly seen a gradual improvement since the April lows.
This is pretty much, in many ways, just like animal health in so many ways. It's a very defensible industry, even during a recessionary period. If you think about this, right? Because there is, people are going to spend the money on animal health no matter what, no matter how much they tighten their own belt. And the same thing goes with kids, and the business of the company performs. So this is fantastic company, and I know some of our clients hearing this are going to be very happy about getting your update on this one, with this note that's out. And the chart sets up beautifully for a breakout. In fact, I think some of our clients from more than a year ago, when you first published a bullish case on OrthoPediatrics, they may still be positioned into this one, because every time when a question has been asked about this in the chat room, we have said just continue to hold, because this is the long-term secular growth, so they're probably still in it. I love this technical setup. I think this thing is going to blast through $50 sooner or later, and I think it's going to make a run towards 55 to 60. And it's less than $1 billion company. Nobody really pays attention to it. You never really get any coverage. Nobody talks about it on Twitter or social media. I think it's a great company. It's going to set up and break out. Great stuff. Avo, what's up, buddy?
Oh, well, you took my pick this morning. I was going to mention SHAK as well because I did see that breakout, but it's okay. I forgive you this time.
Okay.
So that is what I was looking at today. So otherwise, sticking with the takeout food, because even though New York has started to reopen, I don't think the dine-in options are available at this time. I think that's in a phase 3 type of situation where we're at phase 1 over there. I was looking at Clearwater last week, and they provide packaging to restaurants for takeout products. Now, I don't know how widespread they are, but this is one I would keep in mind. And to a lesser extent, there was also Westrock, but I don't think they do restaurants as much as frozen packaging among their food products. So that might be an option too. But I like Clearwater more for takeout purposes. Now, on the other hand, Westrock, WRK, with all the boxes being shipped, they make
Container
boxes.
boards.
They make boxes. Yeah, exactly. Cardboard. That's the word I'm looking for.
Yeah.
And the other one that I would keep an eye on is CAE, the flight simulator
Simulation.
company.
Yeah, I'll say one thing, and I don't know if many of you remember the Panera Bread acquisition. You remember that a couple of years ago when the Panera Bread was acquired for a very healthy premium?
Yeah, it went private, right?
Yeah, and so one of the main reasons why the acquisition was done for such a very nice premium, this is going back to SHAK for a little bit, was because the company was showing tremendous amount of progress for its digital efforts. And there was a new theme emerging because every time I've been to Panera Bread myself, all before COVID shut down and everything, there were just lines, pick up food, whether you were getting a cup of coffee or whether you were getting a scone or anything, or you were just ordering food, and the dining room was always packed. It just seemed like, I didn't want to be there. I just wanted to get my food and get the heck out. So they get into this digital mix and gradually started to take off, and overall the business actually boomed from that. And then people started to realize there's a tremendous workaround that the company can do to continue to push towards digital mix. And as a result, the overall sales, while your dining rooms are still running full, your overall sales could be sharply higher than what they had been previously in the projections. And for on all those digital mix experiences and the technologies that the companies was doing is what the reason why Panera Bread was acquired and became a great compounder of growth for a lot of people. So Shake Shack could emerge exactly the same way. And I think a lot of these restaurants are going to have to work around to get to the same level of digital mix, in my opinion, in this post-COVID shutdown. And I think that wave is coming. I'm very impressed with the 82-83% digital mix that Shake Shack has already achieved. And I think that's positive trend for the long run. Great stuff. All right, folks. Thank you, everybody, for joining. And that's it from us. I will see you in the chat room shortly.